Everyone wants more yield. That's the truth of every bull market. No matter how many times people say, I'm long-term, deep down, everyone's chasing one thing: higher return with less effort. And that's exactly how the story of res-taking begins. On the surface, it looks like free money. You take what's already earning, you stake it again, and suddenly your yield multiplies. Sounds perfect, right? But the moment something looks too perfect in crypto, it's time to slow down and ask, who's really taking the risk here? Let's start with what res-taking actually means, because the word itself can sound confusing. Imagine you already have Ethereum staked. You're earning rewards for helping secure the network. Res-taking means you take that same staked ETH and let another protocol use it to secure their system too. In return, they pay you additional yield. So, one piece of collateral, multiple income streams. In finance, that's called rehypothecation. In crypto, it's called innovation. But deep down, it's the same concept. The same dollar is now backing more than one promise. Now, to be clear, this isn't automatically bad. In fact, it's one of the most creative ideas Ethereum has seen since DeFi summer. The pioneer here is EigenLayer, a protocol built to let developers borrow Ethereum's trust layer without rebuilding a new validator set from scratch. They call it shared security. And from a technical point of view, it's brilliant. Instead of starting a brand new chain and begging people to stake for you, you can borrow security from the biggest network on Earth. But brilliance in design doesn't mean zero risk. Because when you stack layers of promises, the smallest crack can ripple through them all. Here's where the story gets interesting. Res-taking isn't just about earning yield, it's about trust delegation. When you res-take your ETH through a liquid staking token like SDTH or RETH, you're basically saying, I trust EigenLayer to manage this extra layer safely. That trust isn't on-chain logic, it's social. You're trusting smart contracts, slashing mechanisms, and governance. You're trusting that nobody's going to misuse the collateral you've provided. And that's where the hidden risk hides, not in code, but in coordination. Think of it like this. The base Ethereum validator set is like the foundation of a building. Solid, slow, proven. Res-taking protocols are the upper floors lighter, newer, experimental. As long as the weight is balanced, the building stands tall. But when too many new floors are added without checking the base, the entire structure becomes fragile. A small error at the top can shake the bottom. In Ethereum's case, the risk isn't losing ETH price. It's losing the social confidence that ETH staking is safe. And that confidence is what holds the ecosystem together. Let's look at the incentives, because they always tell the truth. Right now, base staking yield on Ethereum is around 3 to 4%. With res-taking, some projects advertise 10 or even 15% combined yield. Where does that extra money come from? It comes from new protocols, AVSs, short for actively validated services, paying for the security they borrow. In the early stages, they're paying with tokens, just like the early DeFi farms did. That means the reward looks high because the risk is being priced in tokens, not in stable value. It's marketing yield, not guaranteed yield. And yet, people rush in because it feels new. This cycle always repeats. First comes innovation, then hype, then leverage, then stress. The key question is, can res-taking break that pattern? Let's be fair, EigenLayer has built strong safeguards. You can set withdrawal limits, define slashing conditions, and choose which services to opt into. But the deeper issue is systemic. When too many protocols depend on the same base collateral, failures can cascade. If one AVS misbehaves, a slashing event could affect not only that service, but the validator supporting it and indirectly the reputation of Ethereum staking itself. That's what people mean when they say systemic risk. Let's simplify. Imagine your friend borrows your car to drive to work. He's careful, so you let him. Then another friend says, hey, can I also use it for deliveries? You'll earn extra. You think, sure, why not? Now your car is being used twice as much by two different people and both promise to be careful. Everything's fine until one of them crashes it. Who pays? That's res-taking in one sentence. Shared use, multiplied profit, shared risk. Now, don't get me wrong, this is not a doomsday story. In fact, restaking could become the backbone of modular blockchain design. It allows new projects to scale faster, to bootstrap trust instantly, and to compete without building an entire validator army. That's powerful. But it also shifts crypto one step closer to a credit-like system. One base asset, multiple claims. And in traditional finance, that's exactly how fragility sneaks in quietly, through efficiency. Let's step back and look at why this is even happening. DeFi is evolving. The first wave was yield farming. You provided liquidity, earned tokens, and hoped the platform survived. The second wave was staking. You locked value to secure networks and earned predictable returns. The third wave, what we're in now, is restaking and modular security. It's more capital efficient, but also more abstract. You're no longer just staking ETH. You're staking trust itself. And trust, once stretched too thin, can snap. So, how do we know if restaking is healthy or risky? There are a few signs. 1. Transparency. If the protocol clearly shows where your collateral is used and what risks you're exposed to, that's a good sign. 2. Slashing logic. If penalties are predictable, clear, and limited, you're safer. 3. Diversification. If your restaked assets are supporting dozens of services at once, you're overexposed. Fewer, stronger partnerships are safer. And 4. Exit liquidity. If too many users restake through the same liquid staking token, redemption pressure can cause instability during market stress. We saw this movie before with Luna. When everyone wants out at once, even good systems crack. There's also a bigger philosophical question. Should Ethereum's trust layer be monetized at all? Some purists say no, that it's too sacred, too systemic. Others say yes, that it's the natural evolution of an open economy. The answer probably lies in balance. Just like DeFi needed regulation after 2020's chaos, restaking needs risk frameworks. The innovation is real, but it must grow slower than greed. Let's talk about the human side. In every cycle, there's a point where people stop asking what something does and start asking how much it pays. That's the danger point. When conversations shift from what's EigenLayer building to how much APY can I get, the market is overheating. And that's when hidden leverage builds silently through derivatives, LSTs, and wrapped versions of staked assets being restaked again and again. A tower of promises. It looks stable until everyone demands liquidity at the same time. If you've been in crypto long enough, you've seen this story before. It's the same mechanism that powered DeFi summer, the same pattern that broke Luna, and the same dream that makes this space exciting, yield from innovation. The difference this time is that Ethereum security is directly tied to it. That's why restaking matters so much. It's not just another DeFi farm. It's the base layer experimenting with leverage. So what should you watch? Simple metrics. How many AVSs are live on EigenLayer? How much ETH is restaked relative to total staked ETH? If that number crosses 30 or 40%, systemic risk rises. Are new restaking protocols offering insane yields with no clear revenue source? Red flag. Are liquid staking tokens becoming dominant gateways for restaking? That concentrates power, another red flag. The key insight is this. Decentralization dies quietly through convenience. The easier it becomes, the more centralized the risk. But there's also incredible opportunity here. Restaking could unlock a new phase for blockchain infrastructure. Imagine an internet of modular services, oracles, bridges, roll-ups, all secured by the same shared trust layer. That's efficient, elegant, and scalable. It means a startup can launch with institutional-level security on day one. That's not hype, that's evolution. The question is whether we can evolve responsibly. Let's bring it back to your perspective as an investor or builder. Restaking is neither good nor bad, it's a tool. Like leverage, it magnifies both profit and pain. Used carefully, it increases efficiency. Used blindly, it amplifies collapse. The best way to think about it is like oxygen, essential, but dangerous in excess. You need it to grow, but too much and everything burns faster. So, when you hear Restaking Wars, what's really happening is competition for collateral. Every new protocol wants a slice of the Ethereum trust layer. Each promises higher yield, more innovation, better safety. The war isn't about technology, it's about who earns your confidence. And in crypto, confidence is currency. Once lost, it's hard to rebuild. If you remember just one line from this video, make it this: yield is never free. Someone somewhere is taking the other side of your reward. Maybe it's a protocol, maybe it's liquidity providers, maybe it's the system itself absorbing the risk. But the risk is real, it just hasn't surfaced yet. That's why the smartest investors don't chase APY, they chase sustainability. So what's the balanced approach? Diversify. Keep part of your ETH in simple staking, part in restaking through a well-audited platform, and part liquid for flexibility. Don't chase every new AVS or every new token incentive. Instead, watch how the ecosystem matures. As real revenue replaces token subsidies, yields will compress, but risk will stabilize. That's when restaking moves from experiment to infrastructure. And that's the real opportunity. Because once the market trusts shared security, the next wave of blockchain applications from finance to gaming to AI can all plug into Ethereum's safety net. That's when crypto stops being a playground and starts becoming an economy. But for that to happen, we have to survive the early chaos. We have to balance innovation with caution. Restaking might look like a small technical upgrade, but in reality, it's a test of maturity. Can crypto innovate without self-destructing? Can we earn yield without repeating 2021's mistakes? That's what this war is really about, not protocols fighting each other, but an ecosystem learning restraint. And if we get it right, this could be the foundation for the next decade of decentralized finance. So, to sum it up in one sentence, restaking isn't a bubble or a miracle, it's a mirror. It shows us whether this industry has truly learned from its past. Yield hunters will come and go, but builders who understand risk will shape the future. And if we treat restaking not as free money, but as a shared responsibility, then maybe, just maybe, we've finally grown up. As always, this content is for educational purposes only. We analyze data, not dreams. None of this is financial advice, it's perspective. You decide what to do with it. Just remember, in crypto, the biggest rewards often hide behind the calmest warnings. Restaking might be the future, but only if we respect the risk that builds it.